Welcome, everyone, back to our podcast, Breaking Ground Commercial Real Estate, the show where big ideas meet real opportunities. Here you'll find conversations that inspire, educate, and empower. Whether it's turning dreams into reality, building smarter investments, or finding the right space for your vision. I'm Kennya Sanchez, and I love helping individuals and investors bring their vision to life, finding the right space where dreams truly become a reality. Thao, we got you here.
And hello everyone, my name is Thao and I also a commercial Hi everyone, my name is Thao and I am also a commercial real estate advisor and we help individual and investor build generational wealth through real estate investment. So welcome to the episode today.
Yes, and today we have a wonderful guest. Our guest today is a dedicated team leader and industry expert with over 30 years of experience across the mortgage, title, real estate, and gift planning industries.
Yeah.
She currently serves as a consultant and director of business development for Equity Advantage and IRA Advantage, where she helps clients nationwide navigate 1031 exchange and retirement strategies with insight and integrity, which is so important. She's a summa cum laude graduate of George Fox University with a degree of management and organizational leadership. She brings both strategic thinking and genuine care to every client relationship. In 2024, she was honored with the Women's Council of Realtors Strategic Partners Award for her leadership and services. She's also deeply involved in her community, serving on the board of Women's Council of Realtors and Cancer Resource Fund. I love that. She's an executive member of the Provisors Lake, I cannot say this, Oswego 2 Group, and a longtime member of the Chamber of Commerce. Please help us welcome Tina Coulson Jones. Tina, welcome, and thank you so much for being here today.
Thank you, Kenyan and Tao. It's so great to be with you, and I really appreciate the invite to your podcast. It's so exciting. Get to talk about everything 1031 exchange today and how investors can increase their portfolios or exit strategies as well, and things to watch for.
That's great. And I love your background, being involved in the Chamber of Commerce, and also the Women's Council of Realtors Strategic Partners. And I mispronounced that word, but what is the provisors?
Provisors, the Lake Oswego 2 group. Yeah, and Provisors is basically a nationwide network of individuals who come together to help clients in multiple ways. So it can include real estate agents, wealth managers, etc. But we're not here for that today. But yeah, Provisors has been a great key group to deal with and network through as well.
Okay, I just wanted to kind of get a little bit of knowledge with that. Okay,
Yeah,
perfect. Thank you for
yeah,
sharing. Well, since we're
absolutely.
here for 1031 exchange today, what is an exchange and what is the benefit to someone who takes advantage of it?
Yeah, so the 1031 exchange was actually created in 1921, and it is an IRS authorized process where like-kind business or investment property is exchanged without immediate tax liability to the property owner. So what we're doing is, in essence, kicking the tax down the road and allowing that investor to grow their portfolio. It gives them more capital to work with when they're buying that new property.
So does that mean that if I sell a condo and I need to purchase another condo, is that what I need to focus on, or can I purchase something different?
Yeah, so when we're talking like kind, it's really more the nature of the investment, not the investment itself. So sell a condo, you can purchase a single family resident, multifamily, commercial property, second vacation home, raw land. There's a multitude of things that you can purchase. The key with the 1031 exchange is whatever you are selling or purchasing, it it must be held for investment at the time of sale. So primary residence doesn't apply to this scenario unless you have maybe a business component with your primary residence. In that case, we can allocate the funds for that business. Maybe it's farm, it could be an ADU that's on your property that you're renting out. And a lot of people during COVID, we had folks moving into a larger primary residence that would allow for a home office. If that home office space is large enough and you're claiming it on your taxes for business, you could potentially take that section of your home toward a 1031 exchange.
Okay.
So a lot of good things that we can do and helping again with that tax mitigation, kicking it down the road.
When we're talking about, any deferrals, is it only the federal tax that's deferred?
Yeah, so federal appreciation is going to be deferred. The depreciation on any property that has been held for business, you should be depreciating on your taxes every year. Whether you took depreciation or not, the IRS still says, yeah, you took it. And that could be up to 25%. So it's the federal appreciation at 15 or 20% that's deferred, depreciation up to 25% on that side deferred. If you're living in a taxable state when you sell real estate and have the gain upon that property sale, it can also be the state tax deferred. And then if you have a client that is in a certain threshold on their income, they may also pay a 3.8% healthcare tax. So all of these categories are going to be deferred from the sale of the property and shifted into that new property that you're purchasing. And you're not going to have a taxable sale or pay the tax on that deferral, I should say, until you have a taxable sale, meaning if you start the 1031 exchange, your goal is to keep doing a 1031 exchange until either you pass away, we call that a swap till you drop, literally, and then your kids get an inheritance, all the gain goes away at that point. So different things to look at, how to grow your portfolio, how to shift some income down to your kids, and that gain again goes away upon the inheritance.
So what role does the qualified intermediary, which is QI,
Yeah.
play, and how does someone choose the right one?
Absolutely. So we, as a qualified intermediary, place we play a legal part in this transaction. When a client receives funds from a sale of a property, they're automatically going to be taxed on gain for that sale if they receive the funds directly. So a qualified intermediary, we're the legal money holder during this transaction. We're going to help with the legal documents before you go into closing. We have our documents that come into play that everybody signs. It allows the qualified intermediary to act on behalf of the client going into that closing. When the proceeds come through, once that is recorded and funded, the proceeds will come directly to Equity Advantage as the QI. So we're the legal money holder from that point forward. And we're also going to protect those funds. So we've got insurance and everything is backed. So if for some reason anything went sideways in that transaction or with us, that client is still protected. And that is so important when you're looking for a good QI to work with. We can't give tax or legal advice through this transaction, but we can provide guidance as far as what the IRS rules are. And a great QI will always ask the client a lot of questions to understand what their individual needs are and how we get them from where they are today, making sure that that structure is accurate and within the IRS guidelines, maybe what they want short term in their portfolio and also long term strategies. And so we can help plan all of that out. But again, just make sure that your QI is asking the questions and you've got that insurance that backs that QI as well.
So what type of property will qualify for a 1031 exchange, and is there a timeline for it?
Yeah. Absolutely. So again, I think I briefly mentioned this, but you can exchange anything that is outside of your primary residence. So that includes raw land. It doesn't have to be leased land. You can be sitting on it for a period of time. We always like to see a minimum of a year, if not longer, that somebody owns that property. Could be single family rental, multifamily, commercial property, a second vacation home. The vacation home rules are really interesting because we want to see that that vacation home is being rented out for at least 14 days per year for 2 years prior to sale, and that the client is not using the property more than 14 days or 10% of the time that it's rented at fair market value per year for 2 years prior to sale. If somebody purchases a second vacation home in an exchange, those same rules apply for 2 years after the acquisition or the closing date on that. So, second homes, really strict rules around it. You can also go into passive investments for somebody that is looking to have an exit strategy. Maybe they own a lot of properties and they're looking to finally unload those rentals and get into something that is simply a check in the mail every month, a 1099 at the end of the year. You can go into passive investments like a Delaware statutory trust, or they call them a 721 UPREIT, umbrella partnership real estate investment trust. Oil and minerals are also exchangeable if you've got a package that allows for the exchange. There's a lot of great options out there. And again, ADUs, additional dwelling units, if somebody has that on their property, or even a shop. Maybe they're running their business out of a shop on their land with the primary residence on that same land. We can always allocate funds accordingly. So many options depending on what the situation is. And we also see scenarios in some of the higher net worth areas where people may have a primary residence and their exclusion of gain. So we look at this too, is if their primary residence is $1 million and their exclusion of gain as a married couple who has lived in their primary home for more than 2 years out of the preceding five, they can get up to 500,000 exclusion of gain on that property. If they've owned that property for a multitude of years and their exclusion does not cover their full gain amount, as an example, married couple filing jointly, exclusion of $500,000 on their primary residence, and maybe their gain when they go to sell that property is going to be 700,000. They still have that 200,000 difference that they would have to pay tax on when they sell that as a primary. We have some scenarios where people, if they've got the means, they will keep their primary home, turn it into a rental property for a couple years, and they go buy their next primary home and move into that. So as their former home sits as a rental, if they've held it a rental for a couple of years, now it qualifies for the 1031 exchange as well. So when they sell it, as long as they sell it within that 5 year look back and they have lived in that home for a period of full 2 years in the past 5 years prior to sale, they still get their exclusion of gain up to 500,000. Now they've got 200,000 that they can use in the 1031 exchange, go buy another investment with that money and still defer that balance of tax. So again, many strategies that we look at as we want to find out what that client wants short term versus long term. There are solutions to it.
So is there a timeline that things have to finish? And if not, then what happens if
Yeah.
someone goes over
Yeah.
that timeline?
Yeah, so with any 1031 exchange, and thank you for bringing me back to that, upon the closing date of the relinquished property that they're selling, if we're doing a delayed exchange, which means you're selling first and then buying something later, upon the closing date of that first property, the client would have 45 days to identify what they want to purchase in the exchange. And they don't legally have to be under contract to identify a property, but they can identify up to 3 properties of any value. They have 180 days from that original closing date to close on the property or properties that they have identified in that exchange period. So if they do not identify anything within the 45 days, meaning that they haven't found anything that has fit their needs for the purchase side, we can always cancel the exchange on day 45. Money comes back to them on day 46, and then it's taxed as a regular sale. The other thing that could happen, which is maybe they've identified property, they went under contract, and then you did an inspection. When that inspection is done, sometimes clients decide to walk away, right? So if they decide to walk away, know that they can always re-identify new properties to us by submitting a new form. And that same 45-day timeline is still set in place, so we can't adjust the timeline. But again, if they're within the original 45-day timeline, they can re-identify, and now we try to close on that new property that's been identified. The worst case scenario that can happen, and we don't see this too often, is if somebody identifies property with us, we're held to whatever that specific address is that they've identified. If we crest over the 45th ID date deadline, and then they come to us on day 60 and say, wait, we can't close on this property that we identified, or maybe we found something else that we like better. Because we cannot go back to correct that ID page for past day 45, if we cannot close on the properties identified, we're past day 45. Now their money is going to be tied up in the exchange account through the 180-day window. That is the worst case scenario. And then we can release money on day 181 or that next business day. We make sure that we're always telling clients this scenario. Day 45 is crucial whenever you're doing an exchange to ensure that you're comfortable that you can close on what you've identified. If not, again, you can cancel your exchange. Money comes back on day 46 or next business day. We don't want to hold money. It is not the goal and the purpose of the 1031 exchange, but it is an IRS rule that we are held to, the G6 rule of when we can release the client's funds. So that's really important when you're looking at those timelines. There's no flexibility. The other thing that I can say too with those timelines is we may get a extension periodically, but it's going to come on a federal level, and it's going to be solely for people who are affected by maybe there's floods or freezing, fires. When we get those extensions, we are told here's the specific counties or states that this extension falls under. And then we also have the client, if they ask us, do we get an extension on this timeline? They need to go back and talk with their CPAs and make sure that that they've got clearance on that end. That's not something that we can dictate on our end per se.
Wow, okay. And that's also for personal reason, personal situations. I'm
Yeah,
okay.
yeah.
Well, if you sell property in Texas or any state, do you have to buy the replacement property within that same state?
Yeah, so you don't, and that's the great news. You can do an exchange anywhere in the United States. So sell in any state, purchase in any state. The one thing that we look at also is territories. So some of the territories that also qualify for 1031 exchange would be Mariana Islands, Virgin Islands, Guam. We get the question about Puerto Rico often, and unfortunately, Puerto Rico does not qualify for the 1031 exchange within the states. You can also do foreign exchanges, so foreign to foreign, but you can't cross over US to foreign. So if somebody wanted to sell in the US and go buy in Mexico, that would not work. And vice versa, you can't sell in Mexico to buy here. So there's some exchange rules when it comes to that.
Interesting.
Yeah.
And what about if the seller does not want to buy and manage another rental property? Do they
Yeah.
have
So
any other options?
back to those passive investments. If they want to go into a passive investment like a Delaware statutory trust, a 721 umbrella partnership real estate investment trust, which are portfolios of real estate, they can certainly go into that if they meet the accredited investor criteria. Oil and mineral is another one, accredited investor criteria. And the oil and mineral, that is one that you need an all cash purchase into. When we're looking at the 1031 exchange, and this is another crucial piece of it, is to have full tax deferral, you want to purchase, let's say you sell, I'm going to back up, you purchase, or excuse me, you sell a property for $1 million, you want to purchase a property for $1 million or multiple properties that equal $1 million in that exchange. You also want to use all the proceeds from the sale to go toward the properties that you're going to be purchasing. So we'll get the question, if somebody has debt on a property, let's say they're selling for $1 million, they've got a $400,000 loan that they still have to pay off in that exchange. A lot of people will say, well, can't I just use, and hypothetical figures, can't I just use my 600,000 proceeds that's coming from this sale and just reinvest the proceeds? The answer is you can, but you're going to have tax exposure on that debt component of 400,000 on that mortgage that we're paying off. What's nice about the Delaware Statutory Trust or 721 UPREIT for investment strategy is a lot of those portfolios may have a debt component built into it already. So in that case, if they're going into those passive investments, yes, we can take 600,000 from the proceeds of their sale, reinvest it into these portfolios that have a debt component that will match that 400,000 that they need to make up in the difference for the value. And in light of that, that's where those Delaware statutory trusts, the 721 UPREITs, really come into play. And it's a great alternative for somebody who doesn't want to go get another mortgage as long as they meet that investor criteria for the accredited investor. So a lot of different things, but it goes back to what triggers tax in an exchange, which we haven't talked about yet. Going down in value. So if you sell for $1 million, purchase for $1 million, if you go down in value on your purchase, you're going to have tax on the difference. If you pull cash out of closing from that relinquished property, you're going to have tax on whatever cash you pull out. If you're paying off any unsecured debt to the property that you're selling, maybe it's for maintenance and repairs and you're paying that outside of closing. Anything that's unsecured debt is also going to be taxable in an exchange. These are more of the questions that we take the deep dive on with our clients and ask, you know, even if they're having seller financing. So maybe they want to carry a note for the buyer coming in to purchase their property. That note could be taxable to them unless they have the funds to offset that note and bring the cash in to closing on their new property. A lot of different variables that can take place. But again, that's why we're here. We want to ask all of those questions and take the deep dive and let the client know what could trigger tax in an exchange.
Okay, perfect. And what if someone finds a property to purchase before they are ready to
Yeah.
sell their current rental property?
Yeah, again, some options that they could do. One, if you can push the closing date out on the new replacement property or make it contingent upon their relinquished property closing first, that's going to keep you in what's called a delayed exchange, where you sell first, buy later. The exchange is all based on the closing date itself. So if you find a new property that you want to purchase and the seller is not flexible on the closing dates, you can always use what we call a reverse exchange. Client has to come in with their own cash funds outside of the money that they expect from proceeds from their sale as the down payment toward that new property. They would get a loan. And then for us, the exchange qualified intermediary, we're going to do a reverse exchange so we can close on that new property first. Then, when their proceeds come from their sale property, we're going to reimburse them for the down payment, pay down any loans we need to pay down on the new replacement side, and then the loan is carried forward by the client moving forward. So a reverse exchange is an option in that scenario. We like to use it as a backup plan because it is more costly and we create LLCs and there's more hoops involved, but it is all doable. Yeah.
Wow, it seems to me that there is more information we need to come back
Yeah.
to on another episode.
We could take
Wow.
hours.
Yes.
Hours.
Oh
Yeah.
my goodness, so much good information that people need to hear. Well, we really appreciate you taking the time to being here with us today. If people need to get a hold of you, they need to find you, where can they find you? And of course, we'll be adding that information on our description as well.
Yeah, thank you. So if you would like to give us a call, we've got several folks here that can also do the consultation piece. We've been in business since 1991, and this is the piece that we really push ourselves on is consulting, making sure the clients have all the answers. But you can give us a call at 800-735-1031. That is our main line. And you can also go to our website, 1031exchange.com. Again, it's Equity Advantage is our company, but 1031exchange.com is our website. We've got a lot of information, whether it's podcasts, videos, just written materials. There is a lot of information on our website. And so feel free to go there. And if you have investors looking for property nationwide, you can also go to post1031.com. Thao, feel free to use that yourself. And it's just a place that we created a couple decades ago for our clients to use and search for properties, list properties. And so many ways to get a hold of us, but all of our links are on both sites.
Great. Well, thank you so much again, and we'll definitely have to schedule another time for us to
Yeah.
dive a little bit deeper into other information.
I
Thank you.
am so happy to be here. Thank you both. And please give me a call anytime. Happy to help.
Thank you. We'll see you guys on the next episode.
Have a great day.
Thank you, everyone.